We're news for business people. Welcome to this special show on Bloomberg Queen. This is a combination show in which we're covering Budget 2018 and our flagship viewer query show, which is Ask BQ. And the reason we're doing this show today is because 13 years after it was actually done away with, long-term capital gains tax has made a reintroduction into the lives of equity investors in this country. Effectively, what the finance minister said in the budget yesterday is that a 10% long-term capital gains tax will be imposed on all equity gains or gains in listed equity of 1 lakh rupees or more, but with 2 caveats. One, no indexation benefits, but your gains up to Jan 31st, whatever the highest price in that stock was on that particular day, will remain grandfathered, so you will not pay any tax there. That makes this not a retroactive tax and a slightly more prospective tax, though one could argue that it would have been purely prospective if it only chose to tax the purchase of shares after the budget, but that's a different argument. Today we're going to try and examine the various scenarios in which you will have to pay long-term capital gains tax: buying price, selling price above buying price, below buying price, above Jan 31st price, below Jan 31st price. And to do that, we have 2 experts with us, Pranav, Sayta of EY and Aashish Somaiyaa of Motilal Oswal. Gentlemen, thank you very much for joining us. Pranav, first, let's get to the simple understanding of when this long-term capital gains tax of 10% becomes applicable. Does it become applicable if I sell shares tomorrow? Because now the budget has been announced. Will it become applicable only April 1st? How does it work? The simplest answer you can give us.
Right. The way the budget proposals have been drafted, Menaka, irrespective of when the budget gets passed by the parliament, gets assent of president, this law will apply to all sale transactions on or after April 1, 2018.
Okay.
So any shares sold on the stock exchange on or after April 1, 2018, this 10% long-term capital gains tax has to be checked whether it would apply and what would be the amount.
Okay. When you sell, let's say on April 2nd, your gains up to Jan 31st, whatever the highest price of the stock was on Jan 31st, those are protected. Those you don't have to pay any tax on. You'll have to pay tax on the gains that you make from Jan 31st to April 2nd.
That's right. So in short, what's happening is any appreciation, which is an unrealized gain really, any appreciation in the price of the stock from my original acquisition till 31st January becomes non-taxable, protected, grandfathered, and appreciation after 31st January till the date of my sale, assuming my sale is after April 1, gets taxed.
Okay, fine. Did you have any quick questions, Aashish, before we get into the nitty-gritties of the various scenarios?
No, I think we should get straight to the ball because there are a lot of questions will come with that.
So scenario one is like this. Your buying price is 100 rupees. Your Jan 31st highest price was 150 rupees. Right. So you made a gain or appreciation of 50 rupees. That gets protected. That is not taxed. Your selling price after April 1st, let's assume you were selling on April 2nd, is 200 rupees. Effectively, that's a 100 rupee appreciation on your buying price, but only a 50 rupee appreciation on your Jan 31st price. What would the long-term capital gains tax be then on this case?
The long-term capital gains on this transaction would be 200, which is a sale price, minus higher of 100 or 150. 150 is the higher amount. Actual cost is 100. Jan 31st value is, Jan 31st 2018 value is 150. 150 gets allowed as the cost. 200 minus 150, 50 becomes your taxable long-term capital gains. No indexation. I'm assuming it's a long-term, meaning the shares have been held for more than 1 year as on 2nd April 2018 when they are sold. And I'm assuming the gain is above 1 lakh of rupees, because up to 1 lakh of rupees it's not taxable.
And so you pay 10% on 50 rupees?
Yes, the tax will be 10% on 50 rupees plus surcharge and cess. So 5 rupees plus surcharge and cess.
Okay, that's fairly simple. Scenario 2, buying price is 100 rupees. Your Jan 31st high price was 150, so you would have made a gain of up to 50 rupees by then. When you go to sell it on April 2nd, your selling price is 125 rupees. So your gain has now come down to about 25 rupees on the original buying price of 100, but it's a 25 rupee loss from the Jan 31st, sort of benchmark price. What is the long-term capital gains there, and what is therefore the tax applicable?
So in this particular case, what we are told is if my sale price on 2nd April was 125, because of my original cost, if there's a loss suffered, I would get it. But I would not be able to compute a loss based on the fair value as on 31st January 18. So here, there is no gain, because from 125, I can reduce whichever is higher, 100 or 150, which means I can reduce 150, but I cannot come to a resultant loss as a result of that 31st Jan 2018 value. So the loss of 25 cannot be computed and allowed to me as a taxpayer. But I will also not be taxable on the gain of 25 compared to my actual cost.
So in this case, the long-term capital gain is zero. Okay,
that's right.
Fine. Okay.
The actual gain is 25, 125 minus the original cost of 100.
Yes, right.
But based on the deemed value as on 31st Jan 2018, there would have been a loss of 25, 125 minus 150, but the loss is not allowable.
Okay, fine. So there's zero long-term capital gains,
correct,
zero long-term capital gains tax, nor can you use the loss
correct
to offset it against any other gain that you make. Right?
Absolutely correct.
Okay, fine. So scenario number 3, buying price is 100 rupees.
Right.
You sell your Jan 31st peak price is 75 rupees. Okay. So you've made a loss of 25 rupees as of Jan 31st, okay? Sure. When you go to sell it on April 2nd, your price is 50 rupees. So you've made another further 25 rupee loss versus your original buying price. There is no long-term capital gain here because you're only making a loss. So therefore, this would not get taxed in any fashion whatsoever. It's only a loss. And you use the loss then to offset any gain.
Correct. So in this case, the cost is 100, 31st Jan 2018 value 75, sale price on 2nd April 50. I get a deduction of 100 actual cost or 75 31st Jan 2018 value, whichever is higher. So I get a deduction of 100 from my sale price of 50 on 2nd April. I therefore have a loss of 50, which I can set off.
Loss of 50 that you can set off against any other gain. Correct? Okay, scenario 4. Buying price is 100 rupees. Your Jan 31st peak price is 75 rupees. So as of Jan 31st, you're making a 25 rupee loss on your investment. But when you sell it on April 2nd, your selling price is 100 rupees, which is actually is a 25 rupee gain on your Jan 31st price, and you've come back to what your original buying price is. So when you compare that to your buying price, it's 0 gain. When you compare that to the Jan 31st price, it's a 25 rupee gain. What would the long-term capital gains in this scenario be?
0. So your sale price is 100. I would get a deduction from my sale price of 100 of higher of the actual cost 100 or 31st Jan 2018 value 75, higher being 100. From the sale price of 100, I get a deduction of 100. Capital gains is 0, loss is 0.
Okay. Scenario number 5. And that is your buying price is 100. Your Jan 31st price is 150 rupees. So you made a gain as of Jan 31st. When you sell this on April 2nd, your selling price is 90 rupees. So not only have you lost 60 rupees versus your Jan 31st price, but you've lost 10 rupees versus your original buying price. In this case, there can be no gain because you've lost on both counts. What loss can you offset, or how do you compute the loss?
So in this case, the loss allowable would be 10, not 60.
Okay.
The selling price is 90, actual cost is 100, 31st Jan 2018 value is 150. Normally, I would have got higher of the two as a deduction, 100 or 150. But because of the 31st Jan 2018 privilege of taking the fair value as on that date, because of that, I cannot get a loss.
Okay.
In short, the sale price of 90 minus the actual cost of 100, only 10 of the loss would be allowed.
And you can use that to offset.
I can use that to offset.
So in this case,
but the loss cannot be 60. It cannot be computed as 90 minus 150.
Okay. Okay. Cool. So any questions?
So if I'm not wrong, just to summarize, when you are selling for a gain, the higher of the Jan 31st price or your buy price will be the determining price.
Correct.
And when you are selling at a loss, the higher price would be the determining price.
Right. When I'm selling, essentially what the law says is that when I take the actual cost, whatever the actual cost is, and I take the 31st Jan 2018 value, if the consideration is lower, then I have to take the consideration or the 31st Jan value, whichever is lower, and compare with the actual cost.
True.
Okay.
So in this case, I take the actual selling price of 90 or the 31st Jan 2018 value 150, whichever is lower. So I take lower of 90. But then the actual cost is 100, whichever is higher, 100 or 90, so I get 100 as the cost.
Fair call. Aashish, any thoughts here? And also if I can throw in as to what would this mean from a perspective of a mutual fund investor as well, because there are people wondering that they've just started SIPs a year ago, less than a year ago. How would this change the tax treatment?
So I think first is that, I think whatever Pranav said is of immense value, because I think some of the selling right now is happening because people don't know. And there is this concept of reflexivity that people start thinking that, okay, others might start selling, so should I start selling? And, what will happen as we move towards 31st March? I think so. Whatever we discussed, I think is of immense value, and people should be clear about all these calculations. Now, when we actually speak about SIPs and mutual funds, first thing we need to keep in mind is that for retail investors, 1 lakh gain in any financial year, so that doesn't count. It's above 1 lakh. So a lot of times what happens, you're doing SIPs since the last couple of years. People are investing on an average 5,000, 6,000 a month. So how much gain is there? That people need to keep that in mind in the first place. The intent is not to tax retail SIP, that type of investment. So when you redeem, if the gain is more than 1 lakh, it's a different story. Second thing to keep in mind is that people will eventually, right now we're discussing all this because there is a lot of confusion.
Right.
And you know, not many people have been in the market 11 years to realize that this is exactly how it was 11 years back.
Go on.
Right. The other thing to keep in mind is that people will eventually go back to making relative assessments of what investment works for them. And you know, ultimately investment decisions will be made based on the gross return that you can get. Because if there is a return, then there is a tax. The tax comes later, the return comes first.
Yeah.
So I think we should let the dust settle and people will get back to the right frame.
We have a couple of questions already coming in from viewers. I think one person has asked a fairly simple question on Facebook. Hariom Panchal has said, what is the position in current situation for long-term one-year investor? I think I'll answer that for you, Pranav. Currently, there is 0% tax, right? For any long-term investor, that is an investor holding listed shares for more than 1 year and selling them after a 1 year holding period, you would have paid 0%. But that was only up to yesterday. Now the new regime, or only up to March 31st.
March 28th.
Yeah, April 1st onwards, the new regime kicks in, and so that changes for you. Here's another question. I thought we had envisaged all the possible scenarios in the 5 scenarios you placed to you. Gaurav Garodia writes in saying, what will be my long-term capital gains if I bought on 31st Jan at 100 rupees and sell on Feb 2nd at 130 rupees, and the high price on 31st Jan was 120. So he buys a share at 100 rupees. The high price on that, and that day he's buying it is 31st Jan. Okay, that day the stock hits 120 rupees. So technically in that day he could have made a gain of 20 rupees, right? But when he sells it on April 2nd, you know, he sells it at 130 rupees.
Today at 130, it's just short-term gain.
Sell today will,
this is a short-term gain.
No, so sell today will not matter, because if he sells today, then he's anyways paying whatever the current.
Or even if he sells on 2nd April, it will still be a short-term gain. Taxable at the rate of 15%, 130 minus 100, 30 is his actual gain.
Okay.
Sale price minus the actual cost.
Okay.
30 is his actual gain, which bears tax at 15%.
Yeah, but let me extend this question. The reason why I thought it was interesting is, let me extend it to, suppose you were to sell on April 2nd, 2019, right, and the same situation prevailed. He's bought on 31st Jan. His buying price is 100. On 31st Jan, it hit a high of 120. When he sells it on April 2nd, 2019,
right,
let's assume, we could assume any one of these scenarios,
sure,
but let's assume that the price is, you know, 150. What would his cost price be then?
I will have to see the exact fine print of the law, but I would feel he would get a cost deduction of 120.
Of 120?
Because that's the highest price as per 31st January. His actual cost or the fair market value as on 31st January, and fair market value as on 31st January is defined as the highest price as on 31st January.
Well, it's a very good question.
So whichever is higher,
on 31st.
Whichever is higher.
Yesterday, because that's how the market went.
This is day before. This is not yesterday.
Day before.
Sorry,
Yesterday was the
31st
first.
Jan,
Yeah. Nobody knew on the
Correct. Nobody knew on that
knew.
day. So I think
there
he'll
were
get the
stocks,
higher of the two.
Yeah.
I would feel he would get the higher of the two. 100, which is his actual cost, 120, which is the highest price of 31st Jan. Whichever is higher becomes deductible from his sale price of 130 or 150.
And if we were to reverse that, if when you were selling next year on April 2nd, if you were making a loss, let's say you were selling at 80 rupees, which is a 20 rupee loss to your buying price,
right,
and a 40 rupee loss to whatever the highest price of that day
only
was.
20 loss
only
would
20.
be allowed.
Only 20 would be allowed. All right. I think one more person has written in saying, is LTCG effective from 1st Feb or 1st April? I think you've clarified that.
1st April 2018.
Okay. Now here's another interesting question, and I think this feeds into what we were talking about. If I bought Infosys in an IPO and sell it now, what will my cost of acquisition be? Will it be the IPO price? Is what Abhinandan Nardekar writes in.
So, unfortunately, the way the law is presently framed, if I have not acquired shares by paying STT, Securities Transaction Tax, as in this case where I've acquired shares when they were not yet listed, or I didn't acquire the shares on the stock exchange, in short, I would not have paid an STT. Then technically the section should not apply, but then there is a provision which says that there will be a notification issued as to in which situations of acquisition this will be relaxed. I would have felt that in a case like this, a notification will come eventually. So there is a provision for a notification when I have acquired shares of an unlisted company, not on the stock exchange, or technically the language used is if I have acquired shares without paying STT, right? which normally means unlisted shares, then unless I fall within the notification exemption or relaxation, I will not get the benefit of this concessional tax rate and, you know, basically the grandfathering benefit.
You will not get the grandfathering.
Correct.
But you'll have to pay the tax.
Absolutely, I have to pay the tax.
But
So
then
you-
on the entire amount will be like humongous, right?
So whatever is the gain, in short, I don't get the benefit of this concessional tax regime.
No, so you're
Unless
saying
I have-
concessional, but it's only concessional because the gain has been grandfathered up to Jan 31st.
That-
If you bought in the IPO at 100 rupees and
That
you've not
is right.
paid STT,
That is
and
right.
as of Jan 31st, suppose the stock listed then.
Correct.
As of Jan 31st, the stock hit 200 rupees.
Correct.
Okay? 2 days ago.
Correct.
When you go to sell it, if the stock is at 300 rupees, you will not get the benefit of 200 rupees as your cost price.
That's
you
right.
will have to account for your cost price as 100 rupees
Yeah.
because you didn't pay STT on it.
Yeah, so Menaka, there are
sketchy though.
multiple things here. This section gives multiple benefits. Up to 1 lakh, capital gain is exempt, not taxable. I don't get that benefit. There is a grandfathering value as of 31st January 2018. I don't get that benefit. In short, this tax regime will not apply to me unless it is an STT paid scenario, both on buy and on sell. But subject to a rider, that if on buy there is no STT paid, but I get a relaxation which the government is empowered to give me through a notification, then I am fine. And it was there, if you recall, this came in even last year for long-term capital gain exemption, that unless you've paid STT
Yes.
on acquisition, you will not get the benefit of long-term
That
capital
was
gain
for
exemption.
shares acquired before 2004.
Correct.
Right.
And my sense is the similar notification will get issued here. That seems to be the intent.
Okay.
But
as we
yes,
stand today,
as we stand today, a notification government has to come up with, which is what the law, proposed law says.
no, so as we stand today,
Yes.
if you bought at 100 in an IPO, the stock listed and hit a high of 120 on Jan 31st. You sold it after April 1st, and let's assume that you sold, the gain is only 80,000, right? You sold it, let's say, at 140.
Correct.
Right, and your total gains amount to less than 1 lakh rupees. You are going to be taxed, and you will be taxed at your original cost price, which is 100 rupees, not the cost price benchmarked on Jan 31st.
No, sub 1 lakh, there won't be any taxation.
No,
right?
no,
This-
that's what
this
he's saying.
tax regime will not
Because
apply.
even because you have not paid STT in the original acquisition of the shares, this sub 1 lakh rider does not apply to you. So if you get, even if you make a gain of less
Right.
than 1 lakh, you will have to pay a capital gains long-term tax on it, which takes your cost price as 100 rupees, which is the acquisition price in the IPO.
Yeah, but
Right,
so
but my feeling is, again, I repeat, I think the notification will come.
Sure, I understand. I'm just saying,
And the
as we stand.
notification, I think, will be at least on similar relief lines as was issued under the old 1038.
No, the reason why I think is important is what Aashish said, that when you use this example, the gains don't seem, magnified. But think of somebody who's bought it into an IPO 20 years ago, and the stock prices have multiplied so
Correct.
many times, the
Correct.
gains would be northwards of multiple lakh
That's
rupees.
why, yeah.
Correct.
And then to have pay long-term tax on that, it just seems a bit off.
Yeah,
But
so
I
I'm
don't-
sure they will
that may
clarify
not be
that.
the intention, actually. Like
Correct,
you said.
correct.
Yes,
I
that's
don't
why- I
think
think
that's
that's
the
why-
intention.
Important to you for you to
Pranav
stress
is
it.
constantly reiterating the fact that there is provision for a notification.
Correct.
He expects a notification,
Correct.
and he expects that they will not illogically start taxing you for some IPO purchases made 15 years ago, 5 years ago, 3 years ago, whatever.
Whatever it is.
Correct.
Right?
Okay. And there is provision for a notification.
Okay.
And very similar notification, provision was there in the law till day before. And that notification was issued for the current tax regime where long-term capital gains is exempt.
Okay. So that you're...
Of course, if you roll back 2 years ago, irrespective of how you had acquired the shares, so long as on sale you are paying a STT, long-term capital gain was exempt.
Sure.
It was only last year that they said, okay, no, unless you have purchased the shares by paying STT, you don't get exemption of long-term capital gain on sale. But then there was a relaxation through a notification provided by the law itself, and then came the notification. So for example, all FDI, foreign direct investments, were exempt, and so on and so forth. So I would feel very similar notification will get issued on this one.
Okay, I have one small question on investor behavior, Aashish. And there's a small example. Let's say you bought shares at 100 rupees. Jan 31st price was 150, and it came from an example that Pranav gave. But I just want to bring it out through investor behavior as well. And let's say the price on March 31st is 300 rupees, which means you've made a gain of 150 rupees. If would investors be compelled to think like this, that let me sell it if it's long term in nature and book that 150 rupees profit, even if I want to hold it for a long term, because I can buy it again on April 1st, my cost price instead of 150 becomes 300 and I don't pay tax on the amount that I've already sold. So it's a twin benefit to somebody who's held it a year earlier, because his cost of acquisition also moves up and he doesn't pay tax on the gains that he's made.
Yeah, so in the unrealistic, very lucky scenario that you suddenly make a huge gain between 31st Jan to 31st March, like a substantial, then I think it might make sense to book. Maybe he's the right person to answer, but then you might want to book for once, because if you sell before 31st March, then there's no tax.
Yeah, and even if I want to hold the stock, I'll buy it again on April 1st.
Exactly. So if the shares are already long term, assuming they're already long term, the investor might be well incentivized to book the gain, actually crystallize the gain on or before 31st March, while the long-term capital gain exemption regime prevails. Claim full exemption of 300 sale price minus his cost of 100. There's no concept of 31st Jan value
but there's no
for
tax.
This year. Yeah, there's no tax at all. And whether to buy it or not, that of course is again a call based on his outlook for that share.
But if he wanted to continue holding that share,
that depends again
then
on,
he can crystallize the gain, as Neeraj and you are pointing out, before 31st March, buy the share again on the 1st of April, and whatever his cost price on the 1st of April then becomes his cost price.
Yes.
Which means that 1 year later when he sells, he has a much higher cost price and therefore a lower gain to be taxed.
Yeah.
Right?
Absolutely, and that's exactly the planning that we were talking about. The only thing I would caution is the meter to compute 1 year of holding starts all over again.
Yeah.
That is one caution point which obviously we need to be aware of, because it becomes long term thereafter only after 1 year. So if he acquires the share on 1st April 18 or 2nd April 18, in order to become long term he has to hold for 1 more year, otherwise it gets taxed as 15% short term gain, the appreciation above 300. The other point that one might want to keep in mind is the provisions of GAR, which is General Anti-Avoidance Rules. I don't think if legitimately someone has done a transaction like this, it should be a problem. But it shouldn't be that I sell and buy almost at the same time.
That's what I was saying.
I think even a 1 or 2 day difference really means that there's a risk or reward that can happen in those couple of days.
Are you seriously saying GAR will be applied to individual stock share investors?
If I buy and sell almost simultaneously, right?
Yeah.
That means the only purpose of doing this was to mitigate my tax. It becomes a question and probably get into litigation. I would avoid that complete simultaneous buy.
So are you recommending to clients that book your gains, crystallize your gains before March 31st and then repurchase your shares, which is also very good for your brokerage income. Repurchase your shares.
So I'm not part of this.
I know. I'm seeing Motilal Oswal as a whole.
No, but I'll tell you something. I was just, that's why I was interjecting. One is that it will become very, very evident, because what is GAR? GAR just gives these guys some right to kind of investigate all these things, and it is to his interpretation what he thinks. He explained it already, so I don't repeat it. The second thing is this is laced with multiple probabilistic, like how many people are there who have been long term in a particular script and have finished more than a year on at this time and are witnessing a significant gain at this time and are expected to hold on much further. So there are so many of these combinations. Last thing, I said something, but I will repeat it. George Soros in his book wrote about this concept of reflexivity. What it means is that there are certain things, if you act on them, then those things change. They don't remain that way. So the point is that if everybody starts thinking that before 31st I have to gain, then there won't be any gain.
That's a good point.
It won't remain. So maybe that is what is already happening.
Everybody is going to do that. I'm not sure large investors would do that at all.
What is happening. I don't know why people are selling.
But maybe small investors might think, oh, let me try and do this.
I'm not a market expert, but let me put it this way. If that's what happens, there'll be, in an intelligent world, there'll be enough people who find an opportunity that in one day the price is going up. So there'll be enough buyers as well. Okay. So I'm not really convinced about this. And there'll be people who will first buy and then sell.
Okay, we won't speculate on what people will do, but this is what the scenario
therefore,
is.
I'm not too sure of that. But let me caution and say this, that while GAR could be something that needs to be fully analyzed, I'm not saying necessarily it will apply. but one needs to be cautious. So if you can space it a little, I think it will be far better.
And you're suggesting
And
buy
absolute
first and
simultaneous-
then sell the you know, the,
but
the
again,
shares you wanted to sell
yeah,
later.
again, what I'm saying is let it not be very simultaneous, almost simultaneous. Is what I would suggest.
I just want to go back to one important question. When we were talking about the notification and IPO investors from, let's say, a few years ago, etc., who have not paid STT, you expect that a notification will come out that will exempt them, because doesn't seem to be the rationale of the government to punish IPO investors. Do you believe the same kind of treatment will be meted out to venture capitalists and private equity players, especially those private equity players that have invested, let's say, in sort of about to be listed companies, etc.? Will they get the same kind of treatment, or because they're a different class of investor, the government may choose?
I would think so. I would think so. And in fact, right now, all FDI, for example, is notified, and so on. So I would feel very comfortable that most genuine situations will get grandfathered. Let's put it that way.
We have one more interesting question. It's come in on YouTube from Zohair Kheriwala. He says, if I earn 1.5 lakh as my long-term capital gains, and I'm assuming he's talking about selling after April 1st,
sure,
then what tax should I pay? Will it be on 50,000 or on 1,50,000?
It will be on the gain in excess of 1 lakh, meaning on 50,000 rupees.
On 50,000 rupees. All right. Okay. So I think that sort of clarifies some of the stock situations. We can't visualize every available situation in the world. One quick question on mutual funds, because the finance minister also said that this will apply to, I think, distributed profits of mutual funds, correct? I am also proposing to introduce a tax on distributed income by equity-oriented mutual funds at the rate of 10%.
Right. So this has got nothing to do, I think, with the long-term capital gains discussion that we just had.
It just kills the arbitrage, but
yeah, it just, if you recall, again, last year what we said was that non-corporate Indian resident shareholders are subject to a dividend income tax of 10%. Which is over and above the dividend distribution tax that domestic Indian companies pay on dividends that they distribute. So over and above the dividend distribution tax that the company paying the dividend pays up to the government, the shareholder, so long as he is not a corporate entity and an Indian resident by and large, pays a 10% dividend income tax on dividend income in excess of 10 lakh of rupees, right? I think that particular tax has stuck now. It's very much there even now after this budget. But mutual fund, equity mutual fund units possibly provided an arbitrage to earn significant dividend income but not have to pay that tax. So my guess is probably that there is on mutual fund, equity mutual fund schemes, a dividend distribution tax that gets introduced of 10%.
So
in fact, I want to ask you a question that, let us say there is somebody who's already earning more than 10 lakhs by way of dividends. Right. So whatever DDT, all that is fine. When he receives the dividend in his account, he's going to pay 10% more.
On dividend from shares?
Shares, yes. But now, let's say that mutual funds give a dividend. So this dividend will be added. So I'm also going to deduct 10% now from my mutual fund dividend.
So this will be a 10% distribution tax that the mutual fund pays.
And then when it goes to the investor, does he have to again pay 10%? Okay.
No, so this is the 10% distribution tax paid by the mutual fund.
Correct.
On the dividend that it is distributing to you.
On the equity mutual funds.
I know, but that dividend has to be of a minimum amount?
No, not.
No, every
dividend.
Every dividend.
So if Neeraj was getting, let's say, 50,000 rupees as dividend, that 50,000 rupees will now come minus 10%.
Correct.
So all mutual fund investors will get dividend minus 10%.
Correct.
Because the mutual fund will be deducting 10%.
It will be 45,500 plus 10%. So whatever dividend we intend to declare, we'll have to first say dividend plus 10% is equal to the payout. That's how we
so your payout will be
basically grossing up.
Got that. Does long-term capital gains tax, this new avatar of it, apply to mutual fund investments in any fashion?
That is right.
How does it apply?
Very similarly. Very similar.
So your units are treated as shares.
Correct. And 31st January 2018 NAV is grandfather.
And it applies only to equity schemes?
Mutual funds.
Only equity
schemes.
schemes.
Schemes in any case were taxable even before.
So now that gets equalized, right?
Yeah. You wanted to make a point, Aashish?
No, I think it's relevant for a lot of high net worth investors. So I'm asking again that let us say the guy through shares he's already earning, and there is a double tax. So the company paid tax, received again paid tax, right? Now the mutual fund is paying tax. So that both will get added, and now on this also again 10%. So double.
Sorry, I'm not sure.
You want to explain that
So
with
I'll
an
tell you.
illustration quickly?
In the mutual funds, till now no tax, right? So let's say you are equity mutual funds. So let's say you are a shareholder of various companies, direct equity shareholder of various companies. You're already receiving dividend in excess of 10 lakhs.
And so you're already paying.
So you're already paying 10% on whatever dividends you're receiving. Now, incidentally, you are also a mutual fund investor because you thought mutual funds are you did that. Now the mutual fund is paying you tax. 10% comes to you. Will you again be made to pay more 10%, just like you're paying for equity shares?
Because the mutual fund is already deducting 10% and sending you the dividend.
So that's an important clarification.
So will you have to pay on that dividend as well?
Correct. No.
No, he's saying no.
The dividend distribution tax is already paid by the mutual fund on the equity mutual fund.
Yeah, but that is the case with equities also, that when a company gives you dividend, he had already deducted the dividend distribution tax and paid it to you. But yet, if your dividend income exceeded 10 lakhs, you had to pay an additional tax.
That's right.
But there is
So it
a
doesn't
chance.
apply to mutual fund dividend.
Not equity mutual fund.
No, that's important. So because people are worried about.
I'm sure there are tons of questions, and we've got plenty more from viewers. But will it apply for international mutual funds bought from Motilal Oswal? Is a question that's just come in, right?
No, so international mutual funds are treated like fixed income in any case. It doesn't, and there the long-term gain is definition is 3 years, and it is taxed at 20% less indexation and stuff. So any which way, the government was never giving any concessions for investing outside the country.
Okay, fine. All right, Sandeep.
Nothing changes.
Sandeep, you got your answer there. Satya Srinivas has asked us questions which are very similar to what we've already answered. If I sell before April, is there any LTCG tax? If capital gains are 1.25 lakhs, do I pay it on 1.25 or just 25,000? I suggest you rewind the show and watch it right after we say goodbye, because we've already answered all of those questions. Thank you. We've got a ton, but we're out of time. We've got to get the next show started. Pranav, Aashish, thank you so much for being here. And shall we say goodbye?
Yep. Thanks so much for watching. Hot Money takes over the action on the other side.